Imagine making $83 billion in just 3 months.
Right, just an unfathomable amount of money.
Yeah, but Wall Street actually gets nervous. Because, you're spending so much cash buying up physical land, metal, and silicon that your free cash flow actually drops by 22%.
Which sounds like a huge red flag on paper.
Exactly. But that is exactly what is happening inside Microsoft right now. So welcome to the deep dive. If you're here to get the real story behind the headlines and, really understand the mechanics of the market without drowning in corporate jargon, you are exactly where you need to be.
Because today, our mission is to decode Microsoft's Q3 fiscal year 2026 financial results.
Right. We are looking under the hood of a massive $82.9 billion revenue quarter. And we want to understand what is driving this growth.
And it sounds counterintuitive at first, but when you break down these numbers, you realize this isn't just a regular quarterly earnings report.
No, not at all.
We are watching a company fundamentally restructure its entire financial anatomy. Like, their pivot to AI is changing their operational costs, their asset base, and their profit margins in real time.
Which obviously has massive implications for anyone holding a piece of this tech giant. I mean, the narrative we're always sold is that Microsoft is simply printing money.
And I mean, they are.
They are. But they are also spending it at an unprecedented rate. They are trying to build the physical infrastructure of AI. So we have to ask, is this a guaranteed path to global dominance or just a multi-billion-dollar gamble?
Right.
So let's get into the baseline numbers first. Just to simplify the fundamental financial data for anyone new to this, let's think of it like a giant household budget.
I like that analogy.
Yeah. So for Q3 of fiscal 2026, total top-line revenue, which is basically their salary, hit $82.9 billion.
Which is an 18% increase compared to the exact same quarter last year.
Right, 18% top-line growth. For a company already valued in the trillions, that is just staggering.
It really is. It requires adding tens of billions of dollars in new sales in a very short window. But, the more important metric for shareholders is what happens at the bottom line.
Right, the net income.
Yeah.
The savings left over after all expenses.
Exactly. After paying all the operating expenses, the data center costs, and the taxes, their net income came in at $31.8 billion.
Oh, wow.
Yeah, that is a 23% jump from last year.
Wait, let's unpack that disparity there. Because if revenue, their salary grows by 18%, but the net income, the actual take-home pay jumps by 23%. That means the company isn't just making more money. They are getting much more efficient at keeping it.
Precisely. They have massive operational leverage, and that leverage has historically been the defining characteristic of the software industry.
Because once you write the code, it's done, right?
Right. Once you build a piece of software or a cloud platform, the cost to add one more customer is basically zero. You don't manufacture another physical product.
You just give them a digital login.
Exactly. So when revenue scales up by 18%, the expenses don't rise at the same rate. And that allows the bottom line profit to surge ahead by 23%.
Okay, but wait. I'm looking at this massive AI build-out. Everyone says AI is insanely expensive to run.
Oh, it is.
So how do you have expanding bottom line growth when you are funding the most expensive technology infrastructure build-out in modern history?
Well, to figure that out, we have to look at what they are actually selling today versus what they used to sell. The numbers from this quarter reveal a stark divergence between their legacy business and their future.
Right, let's compare those service and product sales separately.
So revenue from physical products and traditional software licenses actually fell. It went from $15.3 billion last year down to $15.1 billion.
Down to 15.1. Okay, so if traditional physical products shrank, the only mathematical way they hit an $83 billion quarter is if their cloud and services sector completely exploded to make up the difference.
And exploded is the right word. Revenue from services, which includes their cloud infrastructure subscriptions and AI services like Copilot, it's skyrocketed.
From what to what?
From $54.7 billion last year to $67.8 billion this quarter.
Wow. Okay, so service revenue is growing so fast that it's completely masking the stagnation in their traditional product sales.
Exactly. The growth rate of services is just completely eclipsing products.
We still think of Microsoft as the Windows and Xbox company, like the software in a box company. But looking at these figures, is it even accurate to call Microsoft a software product company anymore?
I really don't think it is.
Yeah, they seem more like a giant digital utility provider, like a water or power company for the internet.
That shift from a product company to a utility provider is probably the most accurate way to frame it. I mean, think about how a power grid operates. A factory doesn't build its own power plant.
Right, they just plug into the grid.
Exactly, and pay a monthly bill based on consumption. Microsoft has positioned its cloud and AI services the exact same way. Companies rely on Azure and Copilot as foundational infrastructure now.
And once you integrate that digital utility into your workflow, you almost never leave.
Right, it's highly lucrative.
But supplying that digital utility requires immense infrastructure. You can't just generate digital power out of thin air. Which brings us to the massive expenses that are actually eating into their margins. Let's talk about the operational costs.
This is where we see the strain on the financial model. Their total gross margin grew 16% to $56.1 billion. But, and this is a big but, the gross margin percentage actually dropped by a full point, down to 68%.
And if you look specifically at the Microsoft Cloud gross margin, it dropped to 66%, right?
Yep, exactly.
Now, a drop in margin percentage usually makes Wall Street incredibly nervous. They want to see margins expanding. What is the mechanism driving that drop?
It comes down to the fundamental difference between traditional software and artificial intelligence. We talked earlier about traditional software having near zero marginal costs. AI breaks that rule entirely.
Because it takes so much processing power.
Right. The cost of generating their revenue increased by 22% this quarter. That hit $26.8 billion. Notice that this 22% increase in costs actually outpaced their 18% growth in revenue.
Wow. So the expenses are growing faster than the top line.
Exactly. And the culprit is the sheer cost of scaling AI infrastructure and the increased usage of AI products by their customers.
So every time a customer queries Copilot or uses AI models to generate code, it's not just pulling a static file. It requires active, intense processing power.
We call that inference cost. Every single prompt requires high-end GPUs to spin up and consume massive amounts of electricity to calculate the response in real time.
Which creates a high variable cost for every single interaction.
Plus, they're spending heavily on the operating expense side to build these models in the first place. Operating expenses overall rose 9% to $17.7 billion.
And a massive chunk of that is research and development, right? Because I saw the Q3 data shows R&D hit $8.9 billion.
Yes. Building a large language model requires paying top-tier AI engineering talent, acquiring vast amounts of training data, and running supercomputers for months on end.
Just to train the algorithms.
Exactly, before a customer ever touches them. So R&D is a huge driver of that total sales growth. Add to that their sales and marketing expenses, which hit $6.8 billion.
Driven heavily by global advertising campaigns for Copilot, I imagine.
Right, so they are trapped in a cycle where they have to spend heavily on R&D to build the tools, which drives the top-line sales, but running those tools is inherently expensive.
It sounds like they are trying to build a high-speed rail network while the trains are already running at full speed. Like, they are making a lot of money, but laying down the new AI tracks is incredibly expensive.
That's a perfect way to look at it.
And laying down those tracks requires actual physical hardware. Let's look at the cash flow and investment efficiency here. Because cash is leaving the building to buy servers and real estate.
We are talking about capital expenditures, or CapEx. This is the money spent on physical assets, and the scale here is historic. For Q3, CapEx was a staggering $31.9 billion.
$31.9 billion in one quarter.
Yeah, that is up 49% from the previous year. This cash went straight into acquiring land, building massive data centers, and buying hundreds of thousands of GPUs.
Just to meet the cloud and AI demand. Which brings us back to the paradox I mentioned at the very beginning of this deep dive. Because they spent so much on CapEx, their free cash flow actually dropped by 22%.
Down to $15.8 billion.
Right. Now, for a beginner investor, seeing cash flow down usually triggers absolute panic. If I'm holding their stock, why is this drop actually a strategic flex rather than a warning sign?
Because you have to separate out where the cash is coming from and where it's going. You want to look at cash from daily operations, which was incredibly strong. The core business generated $46.7 billion in operational cash.
Which is up 26%, right?
Yes. Their day-to-day business is a cash-generating machine. The drop in free cash flow isn't because they are struggling to make money. It's because they are intentionally taking that operational cash and plowing it directly into physical assets.
Ah, okay. So it's like building the electric power grid in the 1920s. You have
Yeah.
to build the massive, incredibly expensive power plants and lay the copper wires first.
Mm-hmm.
You absorb all those massive upfront capital costs before you can start charging every household a monthly fee for the electricity.
That is the exact mechanism at play. Microsoft is securing its own supply chain so they don't face a bottleneck when AI demand spikes globally. And we see this massive build-out reflected in the balance sheet. Their property and equipment assets ballooned to $283.2 billion.
But I noticed something fascinating about how they are paying for all of this. Because usually a historic infrastructure expansion requires taking on massive amounts of corporate debt. But if we look at their asset structure, their long-term debt actually decreased.
It did. It went from $40.1 billion in June 2025 down to $31.4 billion by March 2026.
That is crazy. So they're funding this expansion entirely with the cash their core business is throwing off, not by piling on debt.
Exactly. And this fundamentally improves their asset structure. It gives them incredible long-term efficiency.
Because they own it all outright.
Right. Yes, these new assets, the servers and data centers, they will depreciate on the accounting books over time. But physically owning them means they control their own destiny. They aren't renting compute power at a premium. They own the factory.
So let's talk about what this means for the people who actually own the company, the shareholders. If free cash flow dropped because they're buying up all the world's GPUs, you would assume management is hoarding every single penny.
You'd think so, yeah.
But let's look at the payout, starting with earnings per share, or EPS. Diluted EPS was $4.27. That's up 23%.
And that EPS growth is just the beginning if this strategy plays out. The long-term growth potential for EPS is what has the market so engaged.
How so?
Right now, earnings are being weighed down by the massive depreciation costs of this new infrastructure. But as these AI investments eventually reach global scale and the heavy infrastructure spending plateaus,
Profit margins will kick back in.
exactly, they will violently kick back in. EPS could see massive long-term upside once the heavy lifting of the physical build-out is complete.
Okay, but wait, I'm stuck on something regarding their current capital allocation. They are in the middle of a do-or-die AI arms race against other tech giants.
Mm-hmm.
Whoever has the most compute power wins. Yet, Microsoft returned $10.2 billion to shareholders in just this quarter, $6.8 billion in dividends, and $3.4 billion in stock buybacks. Why pull $10 billion out of that war chest just to hand it back to shareholders? Shouldn't they be putting every single penny into buying more GPUs?
You're touching on the defining tension for tech CFOs right now. But returning that capital while simultaneously funding the AI build-out is the ultimate signal of financial dominance.
That's a flex.
It really is. It tells the market that their operations generate so much excess cash that they can afford to build the future of AI, pay down their long-term debt, and still reward you for holding their stock. It anchors investor confidence.
So they don't panic when CapEx numbers look scary.
Exactly. And it builds the underlying value of the company itself.
Yeah.
If we look at equity growth, total stockholders' equity grew massively. It went from $343.5 billion in June 2025 to $414.4 billion by March 2026.
For a long-term investor, why does that $70 billion jump in equity matter so much?
Well, stockholders' equity is essentially the net worth of the company. It's their total assets minus their total liabilities. When equity grows by $70 billion in less than a year, it proves the intrinsic value of the company is rising.
The business is fundamentally becoming richer.
Right. Even while distributing those dividends. It's a testament to profitability trends that strongly favor the long-term holder, because every share represents a slice of a much larger, more valuable pie.
So if they are generating enough cash to fund an arms race and pay out $10 billion in dividends, where specifically is that cash originating? Because Microsoft breaks its business into three main segments.
They do. And the absolute powerhouse right now is the Intelligent Cloud division. Revenue there grew 30% to $34.7 billion.
30%.
Yeah. And the engine inside that division is Azure, their cloud computing platform. Azure saw an astonishing 40% growth rate all on its own.
Wow.
It is the primary vehicle delivering their AI infrastructure to corporate clients.
Okay, so If the cloud division is practically acting as a rocket thruster, pulling the whole aircraft forward, what is happening to the legacy business? The productivity and business processes segment.
That segment is humming along nicely. It grew 17% to $35 billion. The Microsoft 365 Commercial Cloud grew 19%, heavily boosted by companies paying a premium to integrate Copilot into Word, Excel, and Teams.
So the software people use to do their jobs is still growing fast.
Right.
But the third segment tells a different story. More personal computing is kind of the laggard here. Revenue actually dropped 1% to $13.2 billion.
Yeah, Xbox hardware sales plummeted 33%, and Windows device revenue dropped 2%. The only real bright spot in this legacy hardware division was search advertising, which managed to grow 12%.
So it's like a three-engine airplane. The personal computing engine is sputtering a bit, the productivity engine is humming nicely, but the cloud engine is practically a rocket thruster, pulling the whole aircraft forward.
That's very accurate. The divergence between their legacy consumer hardware and their enterprise cloud AI services is widening every single quarter.
The cloud and productivity engines are completely subsidizing the company.
Yes, and justifying the entire valuation of the company right now.
But, no flight is without turbulence. In their financial filings, management is legally required to be very transparent about the risks they see ahead. We have to look at the risk factors they explicitly warn investors about regarding future financial performance.
And the first one they flag is margin pressure. Management explicitly warns that AI infrastructure investments will continue to increase operating costs.
They are telegraphing to investors that operating margins might decrease in the near future.
Exactly. They're basically saying, prepare for the cost of doing business to get more expensive before it gets cheaper.
Which brings up the scale problem. We know they are taking on massive accounting depreciation for all these new data centers. So the big gamble here is that AI becomes as widely used as electricity. If it doesn't scale as fast as they hope, will these massive infrastructure costs just eat their future earnings alive?
It's a real risk. It might take years for these new AI products to reach the high profit margins of their traditional software. Boxed software had incredibly low reproduction costs. But data center AI has massive ongoing compute costs.
Right.
Microsoft desperately needs wide adoption, what we call scale economies, to offset the massive depreciation of these data centers. If corporate clients don't use Copilot as much as Microsoft expects them to, those expensive data centers sit idle and the profit margins will get crushed.
So they need massive volume and they need it fast.
Yeah.
But there's a physical limit to how fast they can scale, isn't there? You can't just build a data center overnight.
No, you can't. Physical constraints are the third major risk and potentially the most dangerous. Their growth relies heavily on third-party suppliers to actually manufacture the GPUs.
Right, they need the silicon.
But beyond the silicon chips, they explicitly list physical world constraints. Finding permitted, buildable land, securing massive amounts of networking supplies, and crucially, finding predictable energy.
Because you cannot run an AI revolution without staggering amounts of electricity.
Exactly. And the global power grid is not currently built to handle the demand curve Microsoft is projecting.
So the ultimate bottleneck might not be code or algorithms or the genius of software engineers. The big gamble here is whether the physical reality of the power grid can support the digital utility they were trying to build.
It is the defining tension of their current strategy. They are betting that the demand curve for AI will steepen to match and then exceed the massive supply curve of the infrastructure they are currently building.
If they are right, they will own the foundational utility of the next technological era. Well, let's bring this all together. We started by looking at a company that is hitting nearly $83 billion in revenue for the quarter. We've seen the mechanics of how they are fundamentally transforming from a traditional product company into an AI-powered service utility. And we unpacked how they are funding a historic $31.9 billion physical infrastructure build-out completely with their own operational cash flow. They are reducing their debt and still managing to hand $10 billion back to their shareholders.
Right.
The incredible growth in their cloud and productivity services is vastly outpacing their legacy product lines. It's completely reshaping what Microsoft actually is.
And they are managing this monumental transition while keeping their net income growing at 23%. It is a masterclass in leveraging operational scale, even with the very real risks of margin compression and physical supply chain bottlenecks looming on the horizon.
We spend so much time debating the ethics of AI, or marveling at the capability of the latest models. But looking at Microsoft's biggest risks today, it forces you to think about the physical limits of our digital ambitions.
Yeah, that's a great point.
What if the ultimate limit to the AI revolution isn't software at all, but the brutal physical reality of finding enough permitted land and raw electricity to plug it all in?
The future of technology isn't just happening in the cloud, it's happening in concrete, copper wires, and power plants.
Something to think about the next time you ask an AI to summarize a meeting for you. Thank you for joining us on this deep dive. Keep asking the big questions about the data you consume, look past the headlines to find the mechanics of how things actually work, and we will see you next time.